I would just like to respond to some of your queries. Some of you guys have sent me messages and dropped me a few emails, and the question was all to do with and some messages on Telegram, of course. So some of the questions were were all to do with you know, stops and stuff like that. Now, I have something that I would like to share. This is just a clip from the previous class that I had with my students, which was recorded via TeamViewer, and I'm going to use this to actually explain a situation that was actually in play with my students in a live market setting, and how we actually handle this particular situation and this particular trade, and how we managed risk, so to speak. Okay, great. Now, I'm not going to go into the details of what you see on the left side of your screen, because this is essentially what Orderflow is all about. What you see right here is the bid and ask volume. We're saying how many lots are trading at what price, and it also shows at the same levels how aggressive are the buyers and how aggressive are the sellers. You know, pretty much simple as that. So you do not need to really get into understanding all this, because this is like the critical ingredient of understanding what's happening on these particular candlesticks that you're seeing here. Now we're saying this, guys, when you trade using market generated information or market generated data, then all essentially you're looking in is like you're zooming into this particular candle on the spot FX market, and you're looking into, was this bearish candle, like you can see this was a bearish candle, but it had so much going on. It had ultra high volume. That's one thing that we can say, because we have the volume data here from the futures market. And the thing is this, we had mixed signals in this particular candle. Now, how do you handle such a situation whereby you're a day trader, you're looking to actually get some of your pips from this particular session where we overlap session? The volume tends to pick up during the overlap session between London and New York. Then we have the footprint chart right on your left side, and this is exactly what gives you the hindsight on who is winning the battle and who is losing the battle. But the thing is this, just like we say, this is not a holy system. This is not a holy grail. This is not like a perfect system. You will get yourself in trouble. You will have some situations whereby the market makers play their game just like they do always. No data, no news, no nothing. Yet the market is going to plunge or spike or do what it wants. Remember, we say the market is always right. Okay, never argue with the market. So what did I do for this particular example right here? And this is exactly what I want to speak about today. So I have a few minutes to do it. Now, got my buy here, pick my buy here right here. And as soon as I got my mixed signals right here, then I covered my buy with a short. What do I mean by covering my long with a short? By that I mean, when you buy and sell at the same time, you're doing some kind of hedging that most brokers will not allow, okay? Buying and selling at the same time locks your margin. And what that means is nothing is going to happen regardless of where the market decides to go. By that I mean nothing will happen to your equity, okay? And remember, when you're trading, when you're actually in a trade, what really matters is your equity, not your balance, okay? These are basics. I'm very sure some of you guys, most of you people actually viewing this video, do understand that what really matters as soon as you're in the market is your account equity. So when you lock your equity, it means that you have positions that are against each other. Then you have a buy and you have a short. You have a long and a short. But the key thing is this: money management requires you to actually lock your money. If you're long 0.1, or what many love to call 0.1 lots, then you go short 0.1 lots. You know, just cancels out. But you cannot hedge, or you cannot cover your long with a short of, you know, 2 times your initial lot size. If you're long 0.1, then you go short 0.2. What you're essentially doing is you have not locked in your margin, because what happens if the market drifts against the 0.2, then you have increased drawdowns. Why? Because there is some imbalance between the 0.1 and the 0.2. Okay, this is the key. This is the key. So what happens here is that when I had this situation, and this was actually the dilemma, and I got myself in a situation where I had to make myself I had to actually cover this trade with a short, and this is exactly what happens regardless of where the market goes. And it kinda, because when you have irregular volatility, this was insane, because you rarely see this in the footprint charts. But when it happens and you're not sure and it gets you, then just hedge your trade. And this is exactly what I try to teach, and what I try to actually advocate for as far as risk management is concerned. The other school of thought, of course, is placing a hard stop loss, which of course is the sure way of losing money. As we all know, if your stop gets run, and you lose some money. Okay, I mean, so clear. But I cover my short right here I cover my long right here with a short. And the question many traders will ask is, hey prof, hey every ABCD XYZ. Now, how do you, when do you know when to click out, and which side do you click out for? You know, and I will say this: the human mind is designed in such a way that, you know, the psychology of the human trader, the normal average trader, is in such a way that if you tend to click out on the profitable trade. Okay, you click out on the most profitable trade. If you have drawdowns even on several pairs, blah blah blah, you tend to give preference to the winning positions, and you click out, you pocket the pips, you pocket the money, and then you give time for the losing trades to recover. Same way, this is the same thing that applies here. When you cover your long with a short, then it is obvious that you tend to click out on the profitable trade, and it's exactly what I did. So forgive me, guys, I'm just sending you back because there's something I really want to explain here. So I'll have to pause this video, okay? I mean the recording. So I covered my long here, as you can see, with a short. And remember, same position size. Money management rules have to be adhered to. Do not try to twist. Do not break your own rules, because if you do, then you're the catalyst of your own downfall. All right. So what happens is this: then I cover my short right here, and the thing is this: I'm very sure that this is the unprecedented move right here. For some reasons, maybe fundamentals or something coming into play prior to big news events, I don't know. But the thing is, the market is always right. But let's face the facts here. When do you click out? Which is actually the main focus for this particular video today. When do you click out? The key thing is this: you have to have market data, market generated information. In my opinion, this is like the sure way, or like the most accurate and precise way. According to me and my trading team, this is like the best way I can know the next level of profit release, profit taking, the next level of support, etc. So how do you know this? You know this by observing the chart on your extreme left right here. That the market